And the question sort of being batted around Wall Street today and this week is, will there be a big other rally, keep going, before a big downturn? In other words, could this maybe be it? Here to help answer that question is Cheryl Young, private wealth advisor for the Rockefeller Family Office. Cheryl, good to have you on set. Thank you.
Thank you, Brian.
I know from
Awesome
watching other shows such as Closing Bell that you have timed this right. You went heavy on big tech a number of months ago. Congrats, making money. Are you getting nervous at all? Are you starting to trim at all?
Well, it's a great question because I think there has been so much rally in tech. If you look at the major indexes a month ago when I was on the show, 95% of the returns on the S&P 500 came from 10 names, and they were all tech names.
95 from 10.
95 from 10.
That seems a little scary.
Well, it's very narrow, right? So people were talking about the S&P being up, but it's really just a handful of stocks being up. In the last month, now that participation rate has actually picked up in other sectors. The attribution to those big tech names are now 80%, not 93%. So we're starting to see some other sectors start to pick up and rally. Look, it's triple witching Friday, so there's a lot of interesting things going on today. The S&P's rebalancing, and the next week on the 26th, we have the Russell indexes rebalancing.
I know you're kind of an options pro. It's $4 trillion in notional value of options expiring today. I kind of thought we'd see a little more mojo in the market. Like, I know we got Monday off for Juneteenth.
Yes.
Is that more of it? Because normally we get a little more volatility.
Well, we've seen a lot of volume today, but you're right, not a lot of volatility. The VIX is at 14. If you look at the last 52 weeks, the VIX has fluctuated between 13.5 on the low to 34.88 on the high. So we actually have a very low level of volatility today. And historically, our question now is, if this is a historic low on the VIX, is this a calm before the storm?
I mean, you look at the VIX, okay, under 14. It's like there's nothing going on. It's not that Russia moved nukes into Belarus. It's not that we discovered some secret spy base in China. It's not that we've got a ground war escalating in Ukraine. And the market is acting as if none of that is going on. There's almost no geopolitical risk premium in this market, and I can't understand why.
I know. I mean, look at the consumer sentiment numbers that just came out. 63.9. I mean, it just popped up. We were expecting a reading around 60. So I think people are starting to feel a little bit more bullish. I worry there's a little bit of a FOMO going on. You know, we're seeing a lot of investors now chasing names. We're seeing, frankly, analysts now upgrade names that have already had rallies.
Strategists, too. Raising their price target on the S&P 500.
Yep, absolutely. The same strategists, by the way, who were very bearish 6 months ago. So
you sound a little skeptical right now.
I'm a little bit cautious right now. I bought a little bit more of protection this morning. I think of it this way. When I advise my clients, look, if I take the gains of the stocks I bought in October, I'm going to create a short-term tax liability for them. No one wants to pay short-term taxes, and especially in California, where the tax rates are really, really, really high on the California side. So I have to be very careful. I know.
Breaking news, Cheryl. Taxes are high in California.
Higher than New York even. But
hard to believe.
Hard to believe. So when I think about these tech names, if I sell them and take the gains, now I'm looking at a 50% tax.
Yeah,
right?
Now you got some angry people.
And then I have some angry people.
So how do you? Let's say I'm a client. I'm a little nervous. I made a bunch of money in some of these big cap tech stocks.
Yes.
I'd like to monetize that, but I don't want to pay the short term. How do I do it? What's that hedge? What's that protection you talked of?
Yep. So what I'm doing is I'm selling calls. I'm going out of the money. I'm going out to January 24, so I don't get hit and called away this year. I don't usually like to go with more than a quarter, but I'm getting a little bit better premium to go next year anyways, and I can push the tax off to next year if I do get called away. I think it's a great way of staying honest and rebalancing a portfolio because some of these names have had tremendous run-up. And then I'm taking the premium from those calls. I'm getting about 14% to go 10% on the money. It's a good trade. And if I only make 14% in the next 6 months, I'm going to be really happy. Let's be real. I can then take some of that premium by put protection. I can buy puts on QQQ. I can buy puts on the specific names. And that way I lock in the gains, but I don't create a tax effect that's short-term for clients.
It's not just here either. I mean, Europe is outperforming us. Brazil on fire. Again, we could talk about U.S. stuff, but this is a global rally.
It's a global rally, and that gets really interesting because look at what the dollar's done the last year. I think the dollar has probably near-term peaked. I think there's downside ahead of the dollar. And so this may be time to think about adding some of those names that you haven't had in your portfolio. Now, most of my colleagues have been in dividend stocks all year, so they've missed this rally. They've been in cash because they were afraid 6 months ago. So that's where, if you think of driving down the highway, you get on that narrow cliff, you're looking over the cliff going, I really don't want to take this corner sharp in our fast cars, but put the guardrails on. That way we can continue to accelerate around the corner, keep the guardrails on, have those puts in place, stay in some of the names you love, but let's add some international, let's add some of those stocks that have maybe underperformed.